We are covering the hobby loss rules found in Section 183 of the Internal Revenue Code. This is a critical topic because the exam will test your ability to distinguish between a legitimate business activity and a hobby. The IRS's primary concern is preventing taxpayers from subsidizing their hobbies with tax deductions. The most significant change you must know for the exam came from the Tax Cuts and Jobs Act, or TCJA. Before the TCJA, you could deduct hobby expenses up to the amount of hobby income as a miscellaneous itemized deduction. However, the TCJA suspended miscellaneous itemized deductions. This means for current tax years, all hobby income must be reported, but zero hobby expenses are deductible. This creates a situation where a taxpayer can have an economic loss but still owe tax. Let's use an exam-style scenario. A taxpayer, Alex, is passionate about photography. In a year, he earns $2,000 from selling prints to friends, but spends $3,500 on new camera gear, travel, and software. If this activity is classified as a hobby, Alex must report the $2,000 as other income on his tax return. The exam question will be what he can deduct. The answer is nothing. He cannot deduct any of the $3,500 in expenses, even though they directly relate to the income. The entire $2,000 is taxable. To avoid this outcome, a taxpayer must prove they have a profit motive. The IRS provides a safe harbor known as the 3 of 5 year rule. This rule presumes an activity is for profit if it produced a profit in at least 3 of the last 5 consecutive tax years, including the current year. For activities that consist primarily of breeding, training, showing, or racing horses, the test is 2 of the last 7 years. The exam loves to throw in a question about horses to see if you remember this specific exception. If a taxpayer meets this presumption, the burden of proof shifts to the IRS to prove the activity is not for profit. If the taxpayer doesn't meet the safe harbor, the determination is based on a facts and circumstances test, which includes 9 specific factors. The exam won't ask you to list all 9, but it will provide a scenario with clues related to them. Key factors include whether the taxpayer carries on the activity in a business-like manner, maintains complete and accurate books, has the necessary expertise, and devotes substantial time and effort. A common exam trap is a question where a taxpayer clearly enjoys the activity. Enjoyment alone does not make it a hobby if other factors point towards a profit motive. For example, an artist who loves painting but also maintains a business website, keeps separate bank accounts, and actively markets her work is likely operating a business, not a hobby. Here's a mental shortcut to keep this straight on the exam. Hobby income is gross, but the deductions are gone. This reminds you that all income is included in gross income, but post-TCJA, the deductions have vanished. Don't confuse the hobby loss rules with the passive activity loss rules. They are entirely different concepts. The hobby loss rules are a gateway test to determine if any expenses are deductible at all. Passive activity rules, on the other hand, apply to legitimate businesses and limit loss deductions based on the taxpayer's participation level. On the exam, when you see an activity with consistent losses, first determine if it's a business or a hobby. If it's a hobby, apply the simple rule. Income is taxable, expenses are not deductible.